Are you adjusting operating income for operating leases in investment valuation? If not, you may be understating EBIT in your DCF as well as relative valuation analysis. In this video, I cover the difference between finance and operating leases. I also show how to estimate operating lease interest and make adjustment in your investment valuation. First, what is the difference between operating and finance lease? According to US generally accepted accounting principles, the finance lease satisfies one of the following.
Here are the 5 tests that determine the type of lease. If any of these conditions are satisfied, the lease is considered a finance lease. In essence, the asset will have no value at the end of the finance lease term without substantial revamp by the owner. Any other lease that is not satisfying any of these 5 tests is an operating lease.
When it comes to investment valuation, here's what you need to know about lease accounting. Any lease is a form of debt. And whenever you sign the rent agreement, you put yourself under the obligation of making payments for a certain period of time. Moreover, you must record a lease asset and a lease liability on your balance sheet. The lease asset is also called the right of use asset. This is so because you are getting an asset that you can use for a specified period of time.
Here's the table that summarizes how the US GAAP treats finance leases versus operating leases. As you can see, the difference that is important for investment valuation will be on the income statement. A finance lease accounting has 2 main components. These are the interest expense and depreciation expense. Conversely, accounting for operating leases involves only a rental expense that is subtracted straight out of the revenues. The rental expense is typically buried somewhere in the SG&A line.
International Financial Reporting Standards, or IFRS, treat all leases as finance type. If we think about it, it makes sense. A lease is a form of financial obligation that has an embedded interest in it.
US GAAP didn't go far enough and decided to preserve its legacy definition of operating leases. The operating lease liability and asset are correctly recognized on the balance sheet, as it should have been a long time ago. This is good news, since you don't need to capitalize operating leases anymore for your valuation. But the interest expense is swept under the rug and gets buried in operating expenses under the disguise of rental expense.
Why is this important? Because when valuing a company, it is crucial to separate operating items from financing ones. Doing so will allow you to laser focus on and value companies' operating assets.
Unfortunately, the US GAAP wants companies to subtract the entire rental expense from operating leases in EBIT calculations, but there is an interest expense component embedded in the rental expense. This effectively understates operating income. Thus, we should estimate and add back the operating lease interest.
Authoritative books such as Valuation by McKinsey & Company advocate making this adjustment. If you are new to investment valuation, I highly recommend this book. While there are many books on valuation out there, this is by far the most comprehensive and authoritative books on valuation I've ever seen. This way, you'll be able to treat all leases as debt in a consistent manner. Moreover, you'll be able to make comparisons of valuation metrics across American and international companies.
So let's take a look at an example. Consider Kroger. Kroger reported a rent expense of $950 million from its operating leases. All of it was subtracted from the gross profit to arrive to the operating income. Our task is to estimate the interest expense component of operating leases. For that, we need the interest rate Kroger used to discount the operating lease payment. Looking at Kroger's 10K, we find this excerpt. It refers to the discount rate, which is 4.2% in 2022. Further, we can take an average of a discount rate for the past 2 years, which is 4.15%. This may make sense since Kroger likely makes lease payments on a monthly basis. Next, go to the balance sheet and find operating lease liability. Then compute the average balance for 2022. This will be the average of $7,034 and $7,076 million, which is $7,055 million. Then multiply the discount rate of 4.15% 4.15% by 7,055 million. This produces the interest expense of 293 million. After that, add 293 million back to the reported EBIT of 4,126 million. 293 million represents about 7% of Kroger's reported EBIT, which is material for the valuation purposes. In some cases, a company may have an even higher reliance on operating leases. This can make the lease interest adjustment even much bigger.
That is it for this video. I hope you got something out of it. If you did, please give this video a like and subscribe to my channel. I will have more content about investing, valuation and personal finance. Thank you for watching.